Hi everyone, Jennifer Schaus here. We're coming to you live today from Washington, D.C., and we are continuing to cover the DFARS in our webinar series, which is the Defense Federal Acquisition Regulations Supplement. Our webinars every Wednesday and Friday, they are complimentary. You can find all of the recordings and then some, about 750 plus government contracting webinars over on the YouTube channel. It does not cost you anything to download, listen, watch, leave a comment, like any of the videos. So please feel free to do that. If you're looking for the corresponding PowerPoints, all 700 plus are over on slideshare.net. That's also a complimentary site. You can log in with your LinkedIn credentials and download any of the PowerPoints. If somebody sent you today's link and you're looking at or interested in signing up for future webinars covering the DFARS, go to our website, click on the section called the DFARS. Pretty simple. On the left-hand side, you'll find all of our recordings from 2021. So keep in mind that information is probably a little bit out of date as things continue to change and evolve. Everything on the right-hand side is this current year, 2025. If there's a link to YouTube, it means we've already covered the topic, and that'll take you to the recording. And if you see the attendee link, you can obviously register. Pretty self-explanatory. A little bit about us. So we are based in downtown DC and provide a variety of services for established government contractors. If you're just starting out, we direct you over to your Apex Accelerator. Most of our services are listed here with a primary emphasis on helping companies get onto the GSA schedule, manage and maintain their schedule through modifications, audits, renewals, kind of everything A to Z and in between. Speaking of GSA and GSA schedules, GSA through some executive orders seems to be, at least on paper, the primary contracting hub. So if your company is interested in getting onto the schedule, simply drop us an email to the hello@jenniferschaus.com address. In the event that your company is selling to federal contractors, so the banks, law firms, insurance companies, payroll, etc., we do have advertising opportunities in our newsletter, sponsorship at our events, and more. And speaking of events, we've got one coming up Monday, June 23rd over at the Kennedy Center. We've got 6 federal departments confirmed with their attendance, 3 of which are from Department of Defense, and you can see them all listed there. Ticket prices are going to increase on Friday, so grab your tickets soon, and we hope to see you there. Here's some stats if you are interested in advertising with us. Our newsletter continues to grow, and open rates continue to increase as well. Okay, we want to thank our in-kind sponsors, GovEvents. That's the premier platform for posting events related to government and government contracting. Visit govevents.com for more information. The Fairfax County Economic Development Authority has an online calendar of events and webinars in the local DC metro area. You can visit their calendar to find all of our events and webinars posted there. Set Aside Alert is the go-to publication for finding opportunities related to small, women-owned, veteran-owned, hub-zone, and 8A firms. Visit setasidealert.com for more information. The Virginia Apex Accelerator is a trusted resource and DLA-funded organization. That's Defense Logistics Agency. The Apex Accelerator provides local training, counseling, and mentoring for aspiring government contractors, as well as matchmaking events. If you want to sell to state, local, or federal governments, please contact your local Apex Accelerator. You can visit the links on your screen to review the training calendar, locate free resources, and to schedule an appointment with a Virginia Apex Accelerator counselor today. Okay, we also want to thank our paid sponsors. Our friends over at BidSpeed will be with us on June 23rd for the networking event. The BidSpeed platform allows users to research public sector opportunities at the federal, state, and local level. Users can also find anything from a compliance matrix to teaming partners, incumbent point of contacts, expiring contracts, and proposal templates. Discover, manage, and secure government contracts with BidSpeed. BidSpeed is an official partner of the SBA's ETG Empower to Grow program. Contact BidSpeed today. C3. if you're thinking about contracting with the Department of Defense, you need to prepare for CMMC. That's the Cybersecurity Maturity Model Certification. C3 suite of CMMC solutions include C3 Command, C3 Catalyst, and C3 Core. These solutions answer the needs of every defense contractor, whether your CMMC priority is a fast defined path to compliance or you need the flexibility to manage multiple environments. C3 offers solutions. They are your partner with a deep expertise in IT, cybersecurity, and compliance. Contact C3 today. WorkPlan. WorkPlan is an online contract management and accounting tool designed for federal contractors and trusted by Amazon Web Services. Get and stay DCAA compliant, manage expenses, timekeeping, and forecasting, plus use the WorkPlan platform to manage your capture process and your CRM. Contractors can integrate their HR and payroll into this one easy-to-use solution. Contact WorkPlan today. Ateria specializes in Microsoft Cloud licenses and services for government and contractors. They provide a business advantage for Microsoft Government Cloud licensing, managed IT administration and security, as well as data intelligence services and solutions. They implement secure, compliant, and scalable solutions to enhance operations, reduce risk, and uncover opportunities. Contact Ateria for expert IT assistance. Okay, last but not least, before we dig into the presentation, Gov White Papers. Gov White Papers is the central hub for government and government contractors to find and post content geared towards solving public sector challenges. With your free membership, you can add relevant white papers, case studies, data sheets, and more, making your content available to a wider government audience. Have the expertise, but not the content? Gov White Papers can also create materials to meet your specific needs. Join for free today at govwhitepapers.com. Okay, today we're covering the DFARS Part 232, Contract Financing. We've got the dynamic duo of Carrie Palmatier and Nina Lentz. Carrie, I'm gonna put myself on mute and turn the floor over to you. And I wanna thank, again, you and Nina for taking time to put together the slides, as well as taking time to present today. The floor is all yours.
Thank you, Jennifer. It's nice to be back here. So my name is Carrie Palmatier. I am the owner, founder of my own law firm called Palmatier Law. I've been working in the government contracting industry for almost 30 years now, and started as an Air Force JAG doing government contracting at, back in the day, Space Missile Systems Center, and ended up at United Launch Alliance, where I was worked there and learned a lot about the industry. And so for the last 8 years, I have had my own firm helping small, mid-sized businesses navigate this complicated field of government contracting. Over to Nina for her introduction.
Thanks, Carrie and Jennifer. So my name is Nina Lentz. I am a government contracts and grants attorney at the law firm of Frederickson & Byron in Minnesota. In addition to federal contracts and grants, I advise clients on state, local, and tribal contracts and projects as well. Within the context of DoD contracting, my focus is really construction, small business programs, and R&D. Next slide, please. Okay, so I'm going to kick us off here. What you see in front of you is an outline of the sections that are in Chapter 232. In the order that we'll present them, we're going to start with, within 232, the general policies that apply to DFARS contracts that are different than the typical policies for other agencies. Then we'll talk a little bit about how DFARS layers on different policies for commercial acquisitions compared to other than commercial acquisitions. We'll then spend, I think, the bulk of the time here talking about types of financing: progress payments, performance-based payments, and advance payments. We'll then move into talking about debts to the government, if the government pays you too much, and then how the government actually makes sure that they are funding and pacing the funding of the contracts. We'll touch on assignment of claims, where you can assign your contract as a means of financing, and then we'll talk about timing of payments and mechanics of payment. Next slide. Okay, before we launch the DFARS, I'm gonna take a few minutes and 3 slides to talk about the broader context here and some foundational concepts that are really important to understand when we're talking about contract financing for DoD contracts. So first, remember that the DFARS supplements the FAR. It must be read along with FAR 32, otherwise you're going to see 232 is awfully sparse. And then you may have situations where agency regulations like the Air Force FARs and contract provisions layer on contract financing details as well. So make sure that you're following all the way through back to FAR and down to your contract. Point number 2, the purpose of regulations vary. This is true generally throughout the FAR, the DFARS, all the supplements. Sometimes they're providing rights to contractors. And other times they're providing instructions to agencies. We're going to talk about which is which throughout this presentation, but it's really helpful to understand what it is you're reading when you are in the process of trying to negotiate contract terms with an agency. Okay, foundational concept 3. What is contract financing? What are we talking about? In the world of government contract, it's an authorized government disbursement of money to a contractor prior to acceptance of supplies or services by the government. Why would the government do this? The government always wants, and pretty much any buyer, to pay for a complete product, a complete project. After delivery and acceptance, they get their bridge, their jet, their giant research project. Well, contractors, as you probably know, need working capital. You have to cash flow. The performance period, you've got to pay your people, you got to buy materials, your facilities costs. In the longer the period of performance, the more cost intensive it's going to be for a contractor to perform completely in advance of payment for the government. And so the longer and the more capital intensive, the greater the need. And also the smaller you are as a business, the more you're going to need that kind of performance support. And that is why the DFARS and FAR allow for contracting mechanisms during the period of performance. Fundamental concept number 4 here. I talked about the DFARS and the agency supplements layering on top, but it's important that if we're going to think about contract financing and what it means, how it operates, and how it's limited, that we understand the key laws and constitutional principles that stand behind the FAR and limit the ability of agencies and contracting officers to structure any kind of contract financing. Next slide. And so I am going to take you back to middle school civics for a couple minutes. This is a graphic of how federal dollars move from Congress to the American people. Under the US Constitution, as you may recall, only Congress has the power of the purse. This means that only Congress can pass laws to make decisions about how to spend our tax dollars. They do this through laws that are called appropriations. You're hearing a whole lot about budget bills up on the Hill right now. Those are appropriations. And they're laws that provide agencies with a specific amount of money for a set period of time for specific purposes and may have other limitations in them. They're often very, very short laws, but they get stacked together and you get like the 1,000-page budget bill. Agencies then take those appropriations and they can only spend the money that's appropriated by Congress to them. And they have to do it within the limits, those time limits, purpose limits, and amount. Agencies can spend the appropriations. They do this by what's called in the government lingo obligations. Those are promises to pay. In the context here, in the contract world, they're contracts. And they're enforceable promises to pay, but only if they're in line with the appropriations. There's a limitation there. Agencies cannot spend in excess or in advance of appropriations. And this is important because they're constantly going up and renewing the budget. There are some very few permanent appropriations like Social Security and Medicare, where the agency or the Congress has to act to take it away. But in almost every other case, Congress has to act every couple years to fund your programs, the places that you are getting your contracts. And the current Congress can't bind future Congress. It means even if they're funding your program, and it's a program that's there and has been there for a long time, there is always a risk. There's always some uncertainty about what the future Congress could do. So the whole backdrop of this government contract financing we're going to be talking about today is this kind of fundamental uncertainty of federal funding, which right now feels very uncertain and very much like there's a lot of moving parts, that contrasts with the need for these programs and contractors to have some kind of certainty about budget and also just about the very existence. So all of that is the backdrop from a fiscal law, appropriations perspective to keep in mind as we talk here. Next slide. Okay, last context slide. I want to anchor us into a couple basic concepts about government contract financing that are in the FAR. And these are going to sit behind the DFARS conversation that we have, where these things do apply to the DoD and they're important. So the government has a preference, an order of preference, no surprise, for how government contracts are financed. Number one, don't call us. Go to a bank. We don't want to help. Assign your contract to a bank, get a private loan. They have a limited role in that. Carrie will talk about that later, but that's what they would prefer. Not always possible, often not possible. And so the second is customary contract financing. And this is customary is defined within the context of the FAR and then the DFARS as supplemented by it. And it basically means financing that's available for routine use by the contracting officers without them having to go get specific approval or go through a complicated review. And that's really going to be our focus today, talking about progress payments that are either based on a percentage of completion or your costs, or whether you're going to be paid over time based on performance. Third on the list is loan guarantees, which is a Federal Reserve Bank guaranteeing a loan that a private lending institution gives to a contractor. Spoiler, those are not available. Fourth, then unusual contract financing mechanisms. And this is pretty much everything else that's not customary, but that is legal, that is proper, but that there just isn't specific agency approval for contracting officers to do it. So if they want to do something that's unusual, they have to go ask for permission. They have to get specific approval and go through additional review. Finally, way at the bottom of the list, the least preferred is advance payment, which is where the government pays you before you do anything. This is really common in grants. My grants practice, this happens all the time, but that's because the government is delegating a public purpose to an entity to do something that's funded by a grant. They usually can't cash flow it. They're not in it for profit. They pay in advance. Here, when the government is purchasing goods and services for its own use, it is very rare that you're going to see advance payments. And we'll talk about that. Next slide. Okay, let's start digging into 232. General policies, 232, the zero section. First general policy, and these apply out to all the DoD contracts. Their goal is to make quick payments, as quick as possible. 7 days for progress payments, 14 days for performance-based payments where possible. They're also going to accelerate payments to small businesses, with the goal of getting the small business paid 15 days after the invoice is received, regardless of what the contract due date might be. We'll talk a bit more about that. The contracting officer also has to make sure that a contractor is really worthy of getting contract financing, right? They need to make sure that you have the financial wherewithal to cash flow your performance of a contract. And so in the DFARS, there's a lot of details on how to project or forecast cash flow, what the government's going to look at to make sure you're a financeable contractor. And then there are details for when the CO has to perform additional review and what additional review might look like. This is a very detailed section. I'm not going to get into it, but you're going to see a more rigorous review if you are a known risk. That makes sense, right? A performance risk because of the past. But if you're a new company, or a new supplier, if you're going to receive some government property, or if you're going to get financing payments along the way. Next slide. Okay, now we're going to talk for a minute about the DFARS layers for other than commercial acquisitions and commercial products and service acquisitions, and how they're slightly different than the FARs. And this is where really the meat of it is in the FAR. But the DFARS layers on here about progress payments based on a percentage or stage of completion, they're only authorized for construction or shipbuilding. It's okay to use this percentage or stage measure for a different kind of payment that Carrie will talk about. But when you're just doing payments based on the percentage of completion, so 30% building complete, I'm going to give you maybe 20% of the cost of the contract. That really only makes sense in something like construction because half of a building has some value. Half of a research project does not. So this evaluating the portion of payment based on your portion of completion and lining those up is okay in the DFARS context, only in construction, shipbuilding, and other ship things. There is a very limited circumstance when provisional delivery payments are authorized. Here you can think of undefinitized contract actions, which basically just means the government and the contractor agree that something has to happen right away. They haven't worked out all the details, but they're going to get going. This is usually an emergent situation. We need to get these things drop shipped to this base abroad because they really need their, I don't know, bottles of water or whatever it is. In that case, while the profit terms and some other terms haven't been negotiated, the government can pay your costs. They can pay for the cost of supplies or services delivered to and accepted by the government. And then any kind of profit or additional will come in the back end when things have been negotiated. But it's very limited in the DoD context. And then finally, the DoD, the DFARS extend customary contract financing for fixed price contracts that are long, without having to get additional justification. Next slide. Okay, additional DFARS flavor for commercial contract, commercial product and services. So this section is actually really small in the DFARS, but it bears worth mention because the first thing they say is, hey, contracting officer, just because someone is financially responsible, as in they're a responsible contractor for getting a contract, does not mean that they have adequate, they are in a financial condition to provide adequate security for financing. So go back to that part 0 section and do that evaluation. Don't just assume because they're financially responsible under that test in the FAR that they're a good security risk. And then there are some changes to prompt payment terms for commercial products and services that are a little bit different than the FAR. The installment payment concept, this links to the FAR, that you can only pay on an installment basis if market research says that this is a customary practice, and then you can only pay up to 70% on an installment basis before you get to the final payment. Okay, next slide. Contract financing through loan guarantees for defense production, they are not available. There is law, there are congressional laws that authorize this generally, but money has to be appropriated to fund the loan guarantees, and it is not appropriated. Maybe at some future date it will be, not an option today. And now I'm going to send it over to Carrie to really talk through some of the meat.
Thank you, Nina. So advanced payments, we've talked about them. Nina's done a great job of emphasizing they're the last resource for contract financing. And that's because, simply put, the government doesn't like to be a creditor and having to collect on debt, which Nina will be talking about later too. But there are a couple times in where DoD has said that they will provide advanced payments for non-commercial acquisitions. One is a concept that they call an advanced payment pool. where there is an entity where they have a long-term relationship, ideally something like our research and development with a nonprofit, or the management and operation of a government plant. But what they do in that is that it's a pool of money that is paid into it, but subject to a written negotiated agreement between the government and that other entity, and that agreement is incorporated into each of the different contracts. So it's an exception more than a rule, and very limited in application. And the written agreement will have to be prepared by and negotiated with the departmental level contract financing office. So it's not going to happen with your normal contracting officer levels. It'll have to be at a higher level. The other one that's an interesting one is that if you are a mentor in a DoD mentor protege program, not the SBA program, the DoD program, if you pay your subcontractor in advance, so your protege, not just any subcontractor, but the protege. So if the mentor is giving the protege advance payments to help the protege, the DoD will reimburse the contractor, the mentor, essentially in an advance payment situation. So it encourages the mentor to help the protege, and it's all part of the DoD mentor protege program. Otherwise, advance payments are, we can never say something is never possible, but very, very rare. And again, that's because the government is spending taxpayer money and doesn't want to have to try to collect on debts if a contractor defaults, goes bankrupt, damages equipment, et cetera, et cetera. Next slide, please. We're going to talk about progress payments. Now, progress payments are unique, and I'm going to talk a little bit after we get through progress payments and performance-based payments, talk about how they compare to each other. But progress payments are based on cost incurred. Standard process is that the large businesses can receive up to 80% of their progress, of the cost incurred, they can receive payments for up to 80%. For small businesses, they can receive payments for up to 90%. In other words, even with progress payments, the government's not going to cover 100% of the cost incurred with each payment process, because it needs to have a little bit in hold till the end of the contract to ensure that the contract is completed, or if the contract defaults, etc., that there is some money to be able to complete the work some other way. So they don't pay for 100% of cost incurred. There's a standard progress payment amount, and as Nina mentioned earlier, anytime there's a deviation from the standard process, i.e. unusual progress payments, it will have to be approved at a higher level. You're going to have to justify, explain, and how they're managing the risk for the government, etc. So assume your normal contract financing progress payments. The contracting officer can never authorize a progress payment that exceeds the amount obligated. And that makes sense because, again, the contract is being performed. The intent of the contract financing is to help the contractor be able to afford to do the work in installments versus having to go get a bank loan and paying interest on a bank loan. The FAR clause, the 52-232-16, if the small business is a prime contractor getting progress payments, instead of the Alt 1 version of this FAR clause, you're supposed to use another DoD clause. And effectively what that DFARS clause does is that it replaces the 80% for 90% throughout the FAR progress payments clause and elsewhere in the contracts. So that's how they implement the 90%. And then what it also does is that it provides guidance to the contracting officer for how to suspend progress payments, make adjustments to progress payments. For example, if the progress payments have reached, you're halfway through the contract performance and you realize that the amount of cost incurred are actually at a loss, or the contractor is at a loss. And so if the progress payments are continuing, we have to make some adjustments, or if the costs are being incurred in excess of the amounts of it, 80% and 90%, there's ways to make adjustments to the amounts. The hard one is that progress payments, even though they're one of the favored contract financing payments, they do require that the contractor have an adequate system. It doesn't have to be an approved accounting system or cost accounting standards level, but it has to be adequate to be able to support your cost incurred. So in other words, it's not based upon a percentage of performance, it's based upon your cost incurred. So in some ways it effectively converts a fixed price contract for which you're getting, if you've got a fixed price contract and you get progress payments, all of those invoices for progress payments are effectively a cost-based invoice, where you have to show how much of your costs have been incurred by you as the company, by your subcontractors, how much you've reimbursed, your overhead rates, etc. So take that very carefully, and if you're a small business or you're used to the fixed price world, you may not want to be doing progress payments. Next slide, please. Okay, so this is just an interesting slide in that it was created in COVID to show, because if you remember in COVID, we had a change to help with the economy at the time. And what they did was that they allowed for all progress payments to be reimbursed at the 90%, not just small businesses, but at the 90%. So this slide is coming from that era. But what it does is it shows how beneficial that 90% is for small businesses versus the 80%. And you can see visually there that it's the paid incurred cost and your subcontractor cost where that 80% and 90% lines hit as to the amount of cost incurred, but you don't get the full amount until the end of the contract at completion. Next slide. Okay, performance-based payments. These are, especially in the R&D field or in services field, are something where it's hard to calculate the amount of cost incurred, are fairly normal. They may not be on the list of preferred contracting financing that below progress payments, but I see them a lot. And the benefit for them is that they're not based on cost incurred. So especially like a small business or a commercial company that's doing non-commercial work for once, you don't have to be able to prove the amount of cost incurred. All you have to prove is that you performed to that milestone. And we're going to talk about what milestones are, but you have to perform to that milestone. Once that milestone is complete, you will receive the amount of money associated with that milestone, even if you underrun or overrun. So if you overrun, you're only going to receive the amount up to that milestone. If you are underrunning, you're going to still receive the amount of that milestone. And this does occasionally create some discussions because government doesn't want to pay for cost if they haven't been incurred, even though it's a milestone-based concept. And the contractor usually wants to try to get additional payments so he or she doesn't have to get a loan if they are overrunning. But the contract is the contract, and what you get paid is what's on the milestone. The goal is to pay performance-based payments within 14 days of the milestone being hit, assuming the contractor invoices on schedule. Milestones are interesting, and we're going to show some examples of some milestones later on, but milestones are negotiated. They have to be a performance point in time. Such, in kickoff meetings, everybody loves to do upon contract signature, upon contract kickoff, but they're tightly watched because essentially there's a view that they're an advance payment because there's not really been any real work associated with the amount of money paid for that time frame. But your milestones have to be provable, something that you can show, hey, we did this, we submitted this item or report or deliverable. We have, one of the ones that is liked is being able to show that you have paid subcontractors for long lead materials. So it's not an advance payment because the long lead materials have been ordered and there's a contract obligation for them. So that's another good milestone. But essentially the government is going to assess the timing and the value of the milestones. So making sure that they're not too front loaded, where you're getting a high percentage of the price of the contract early in the contract performance. They're going to want to see them phased out, and that the milestones are provable. So be prepared that these will require a negotiation. Also, there is a link in the DFARS to the DoD tool and guidance for how to negotiate and estimate and draft milestones. So I recommend if that's where you're going to be sitting, you get familiar and you're working with DoD, that you go read the DFARS language and your clause and make sure you are understanding how milestone payments will be negotiated and structured. Another one, you don't have to have an approved accounting system. You don't have to have a quote unquote adequate accounting system, let alone a CAS compliant one, but you must be GAAP compliant. And if you're compliant, if your accounting system is just a basic system, you're not going to be eligible for performance-based payments. You have to be GAAP compliant, and you have to consent to a DCAA audit of your existing accounting system. DCAA will not audit GAAP compliance, but they will audit as to whether you have the ability to support the milestone payments. If you certify that you are GAAP compliant and you are not, that is a false certification, and there's another training on that one. So there are different clauses. So in the FAR, we're going to have your performance-based payment clause. That will apply. If you're working with DoD, there's going to be additional DFARS clauses to provide additional guidance and rules for whether you're making the performance-based payments on the whole contract or on a deliverable basis, item basis. So whole contract meaning we set up the milestones along the lines of the contract performance. Item-based meaning once you have delivered a specific item, you can get paid for that item. And so there's subtle differences in the DFARS clauses. Next slide, please. So here's some of the points that we talked about that in the guidance review. This one actually came out of GAO, but here's some ideas that it shows. You have to have the ability to define an objective milestone. So if the contract doesn't lend itself to defining objective, meaning there's a provable milestone, not something of the contractor is ready to be able to perform. Well, that's subjective. You have to have objective milestones. You have to have time to negotiate milestones. So if everything is urgent and the contract has to be awarded within a very short time frame, you may not have the time to negotiate milestones, so performance-based payments may not be optimal, and you may have to go to progress payments. The accounting system, how adequate it is, and whether it can support progress payments or performance-based payments, or neither. And if you have a preference, and I would argue that any contractor who is in the fixed price world, non-traditional defense contractor, usually in the commercial world, unless you are intending to grow and become a cost reimbursement level contractor with more, approved accounting systems, et cetera, I would not move towards progress payments. And I would argue that you should try to ask for performance-based payments, assuming you have objective milestones. And then you have to look at what's mutually beneficial to the government and the contractor. If the government says, we don't think this is an objective milestones, or we want to make sure that we're not reimbursing you for more than what you have incurred, there could be a discussion, and that can be part of the decision-making process. Just remember, contract financing payments are not a guarantee. You start with a first assumption, which is you fund your own contract. Next slide. This is a great comparison slide that shows the different elements and how progress payments and performance-based payments compare. So if you want to receive up to the total financing payment, performance-based payments are 90% for small businesses, 80% for large businesses. Large businesses on progress payment, not sure where we got this from, but those numbers are a little tweaked. So the sources from GAO is a little old, to go back to the DFARS clauses, but the benefit of performance-based payments is not the total financing payment amount, because PBP, you can't exceed 90% of the contract price, but at any given point in time, your performance-based payment amount can exceed or be below your cost incurred, because again, you're getting paid on completion of milestones. Progress payment, it will be based upon each invoice that you submit will have the justification to say, here's my total cost incurred, and you will get, if you're large, you'll be paid 80% of it. If you're small, you'll be paid 90%. Accounting systems, you have to have a government assessed compliant accounting system for progress payments. And that's because you're invoicing on cost incurred. If you don't have that kind of an accounting system, you can't show cost incurred. And while there is no, for performance-based payments, you have to be GAAP compliant, but the government likes adequate accounting systems. The financial statements, you may have to submit financial statements, you're going to be subject to DCA audits. So you have to be able to show that your system is not just too simple. So there's growth there. Pre-award analysis, nothing under a progress payment. The contract can just allow for progress payments. So this is why the government likes them. They're easy for the government. There's no analysis. You have an approved accounting system. You can show that you can collect your cost. Each invoice shows all of your cost, and the government pays you the percentage of your cost incurred. Milestone payments are harder to set up. You have to analyze them, negotiate them, figure out the events, the criteria that support that event being met, and a value for that amount. It's part of the contract negotiations. And depending upon the complexity of your milestone payment plan, it can take months to negotiate. But it's, sometimes it can be more beneficial. Neither one of them are optimal. It's just going to depend upon what your company is ready for. Post-award analysis, that is more complicated for progress payments because the contractor has to prepare a detailed cost package to go to support with the invoicing to show that it has incurred the cost. Whereas with a performance-based payment, all the government has to do is validate that the milestone was completed and pay that amount. Again, there's no optimal one is better than the other. It will depend upon your company's practices and the types of work you do. Next slide. Okay, so here's a good slide that shows another difference. Progress payments, the contractor can submit an invoice every month with its costs incurred for that month and get paid for that month's work. That does also require that you invoice monthly, and you have to be able to have a system that supports a monthly invoicing. Performance-based payments, you can see the green dollar box on progress payments is monthly. On performance-based payments, and of course, this is a notional concept, the landing gear machining is complete. Once you hit that, you're going to get paid some amount of money. You've delivered the landing gear. That may take a couple months, and this is where understanding your contract performance schedule to align with the performance-based payments schedule, your milestone payment schedule, that's where you're going to pick events. And you can see that right now the gearbox installation will be in the future, and you will be paid once you've hit that milestone again. So milestone payments there's bigger intervals, longer intervals between them, whereas progress payments are monthly, but progress payments will require you to submit more detailed cost information, whereas the performance-based payments will only require that you show that you completed that milestone. Next slide. This is an interesting slide. It's from 2023, so a couple years old, but it shows by program commodity, when they use progress payments versus performance-based payments. Progress payments are on top in that gold yellowish color, and performance-based payments are in blue. Different industries have different allocations. And I work a lot in missiles and space systems and can tell you that a lot of those progress payments are because space is not cheap. So the bigger contractors that have the approved accounting systems are getting progress payments. And again, it just depends upon the level of your accounting system and whether you want to negotiate the milestones or having to prepare invoices with the progress payments and what your government customer is willing to offer. Next slide. Okay, back to Nina.
Thanks, Carrie. So contract debts, the government paid you too much money. Government debt. Most of the substance for the contract debt section is really going to be in the FAR. The DFARS doesn't add a whole lot. It adds maybe the identification of different parties within DoD who are tasked with figuring out whether there's an overpayment, how much it's worth, how to issue a demand letter and calculate interest, how to refer the debt for collection, and then should the contractor go bankrupt, what happens then? So there's not a whole lot in the DFARS here, but there are just some different points of contact. Even the PGIs, which sits alongside the DFARS, the policy guidance and instructions, I think, adds virtually nothing to this section. So really look to the FAR for the meat of it. Next slide. Okay, contract funding. So remember that a contracting officer and agency cannot spend in advance or in excess of what they get from Congress through appropriation. The law that says that is the Anti-Deficiency Act. This act is actually referenced in the FAR. Generally, contracts are fully funded. So you see option years, right? You have the funding for a specific year, and then the government exercises the option year after year. Fully funded means that all of the funds that are needed to cover a firm fixed price contract are in the government's bank account or in the agency's bank account from the appropriation, or the total estimated cost and fee for cost reimbursement is available for outlay. You can compare this with incremental funding, which is having the contractor do something and the contracting officer not actually having all the funds yet for what's scoped out in the contract. This is not preferred. Very limited cases in which incremental funding is authorized for firm fixed price contracts. And it's really, as it says here, for severable services. So you can say this portion and then this portion. And it's not more than 1 year in length. And it's funded using what is available. Or this actually is fairly common in the R&D context. But other than that, I really haven't seen it much. If you have a contract that is incrementally funded, there are some rules that are going to come in there. There's a DoD clause. I don't have it listed here, but it's 252.232.7007. It's limitation of the government's obligation. If that is in your contract, it's going to say, hey, this contract is incrementally funded, and for this line item, the total price we have available for payment is this. And then there are a whole bunch of things you have to do to make sure that you are not performing in advance or getting ahead of that funding. One of the key things that you have to do as a contractor in the DoD with incremental funding is you have to tell the agency when you're getting close to hitting what's funded. So at least 90 days before you hit your 85% of the amount that's funded, you have to tell them. And then the agency will decide whether or not to issue additional funding for the contract. If you don't have additional funding, or if they haven't approved it, anything you're doing is not just at risk, but not authorized. The clause is very specific that the contracting officer has no authority to accept voluntary services. Anything you do to get ahead of this is not going to be available in a termination for convenience. because your termination for convenience contract value against which the government would resolve and settle you out is limited to that incremental funding. So it really is very risky to go ahead and do anything in advance of that amount. Loss of funding on an incremental contract, but also just generally, Congress changes its mind. The agency priorities change. That's going to lead to a stop work order, potentially while the government figures out if they can find more money or what they're going to do, often followed by then a termination for convenience. And that's a subject of a different DFARS section, but those are going to happen if the contract funding goes away, which is always a risk. There's always a risk of termination for convenience because of the precarious nature of federal funding appropriations. Next slide, and I'm going to turn it back over to Carrie.
That mute button thing. Okay, so contract financing, assignment of claims, Anti-Assignment Act. Essentially, if you remember in the FAR Part 32 training, you talk about the assignment of claims. There's an Anti-Assignment Act where you can't assign government contracts to somebody else, effectively subcontract out or transfer the whole contract to somebody without the government's permission. But there's also another element of being able to assign the payments from the government for the work performed to a financing institution or bank. So if you obtain a government loan, SBA loan or otherwise, many times the bank will be willing to use a government contract as your security because the government pays its bills. That assignment of payments, so in other words, when DoD issues you the payment will go to the bank and not to you. There's rules because the government, wants to make sure that the payments are paid properly and that if there's complications in the financing situation, that you can't come against government for additional sets of money. In other words, get paid twice because one payment goes to the bank. For DoD, the financing payments for provision of financing payments is only applicable to personal services. If you're providing something other than personal services, they cannot prohibit you from assigning payments to a financing institution, like a bank loan again. And then generally the DoD requires a no set-off commitment in connection so that the set-off happens if you have a financing payment made to the bank and there's an amount too much or too low, or the government has a set-off right against you, such as the debt collection or some other right, that if the government has an interest to maintain that ability to set off payments, they can do so. And again, so the set-off happens in your government contract. If you are overpaid, the government can set off and deduct the next invoice and not pay you as much. It's harder to do that with a bank because the bank doesn't owe the money back to the government, the DoD. The contractor owes the money to the DoD. The bank is supposed to be paid its regular payments. That's what we're talking about, is whether the DoD can have a set-off in its side of its payments, and that's going to have to be negotiated. Next slide. Prompt Payment Act. Again, strongly recommend you take the FAR Part 32 training, but essentially the government has to pay its invoices within 30 days or else it's subject to an interest payment. The DFARS says if there's a natural disaster or some other activity that doesn't allow for normal business operations, they can take longer than 30 days to make the prompt payment. And for small businesses, the prompt payment goal is again within 15 days unless required earlier by the contract. Just so you're aware, so the Prompt Payment Act has the interest. If it's more than 30 days, none of the times we've been talking about in this training where there's an accelerated payment, whether it's 14 days from your progress payment or 15 days for small businesses, the only way that you're going to get interest on a late payment is if it's more than 30 days. Next slide. Okay, so the government will use, there's an electronic funds process. So it's no longer emailing in your invoices or, submitting to the contracting officer or any other way. It is now what we call WAF, Wide Area Workflow, and it is the mandatory process within DoD for how you submit invoices and related documentation. I strongly recommend that if you are going to be working with DoD and you're looking at obtaining a DoD contract for the first time, you read up on the WAF process, because you have to be registered for it and you have to be able to submit all of your documentation and all of your invoices through it. WAF clause, the clause that includes the WAF requirements, has links for training materials and how to get registered in WAF. And this is another area that if you're a small business and you are learning WAF for the first time, go talk to your Apex Accelerator. But also make sure you take that training. Next slide. Okay, some key points are that contract financing is shifting the risk of performance from the contractor to the government. The normal assumption is that the contractor will be paid upon completion of all of the work. That means the risk is entirely on the contractor to go find ways to pay subcontractors, pay wages, pay all your costs incurred without having received payment from the government. The financing is a way for the government to help the contractor with the cash flow by receiving payments before completion. So that's shifting the risk to the government. The government doesn't like to be a creditor. It doesn't like risk. So these are why these controls are put in place. Fiscal law may limit what types of activities and what types of financing payments the government can do because of this shifting of the risk, where if a contractor goes bankrupt or can't complete, defaults on the contract, the government is now out, doesn't have the money to complete the performance because they've paid a significant amount of money to the contractor, and will until it's collected through the termination for default process or through the debt process, can't recover it. So there are limitations on how much risk the government can bear. And we've talked about those with the 80%, 90%, and other limitations. As always with an agency supplement, you definitely have to read the FAR part with the DFARS part, and don't forget that the DFARS part also includes the PGIs. And for both of them, they also include the clauses. So I strongly recommend, again, Jennifer does this great thing. Well, last year we walked through all the FAR clauses, and now we're walking through the DFARS clauses. I strongly recommend you take both of them if you're in the DoD world. Other key points are that the accounting systems will matter, so that the adequacy of your accounting system will determine what kind of financing you get. Your adequate security, the ability to show the government that you're a secure contractor and you're not at risk for going bankrupt, will matter. Commercial financing terms are available. And the other key point is that you need to read the draft, whether it's an RFI that's gone out, an RFQ, or a research request for information, a request for quotes, or a request for proposals. Read them carefully, especially in the Q&A, the open question period, because the government will indicate in the solicitation whether they are willing to consider contract financing. And if you don't see that in the various solicitations, especially during the draft phase, you should ask if you really need contract financing, because if it's not in there, that shows that it's willing and your proposal is based upon an assumption of contract financing, you could be found non-responsive. So do ask those kinds of questions and make sure you review your solicitation. Okay, next slide. So there's Nina's contact information. My contact information is on the next slide, and feel free to reach out to both of us in LinkedIn or for additional questions. We're both very friendly and love to talk with people, especially others who like the FAR and the DFARS. Thank you, Jennifer.
Great, thanks, Carrie. Nina, any last parting words?
No, I think Carrie wrapped it up nicely.
Okay, super. Thank you, ladies. Great to have you back with us. And I know you guys have a couple more webinars with us to get through. So again, I really appreciate your time and just being great colleagues to me and the government contracting community as well. If anyone's listening to this recording on YouTube, give us a like, leave a comment. We would love to hear from you. And a friendly reminder, June 23rd, 2025, over in the Kennedy Center in Washington, D.C. You can meet with about 200 plus government contractors and these 6 confirmed federal government agencies. We've got a few sponsor tables left, not many, and a few tickets remaining as well. So registration link is there at the top of the screen. We hope that you'll join us. And again, thanks today for tuning in for this DFARS webinar series. We're going to pick up part 233 on Friday at 12 o'clock. And again, thanks to the outstanding ladies, Carrie Palmatier and Nina Lentz. Thanks, everybody.